All right, good day, folks. This is Silas from Seasonal Swing Trader, and got a question from a follower about how we define the profit objectives and the risk objectives of the popular 1-2-3 pattern. Now, the 1-2-3 pattern is a very standard, historically reliable pattern, whether you trade stocks, commodities, currencies, even use it to trade options, as well as intraday. And this is a pattern that I first learned when I started trading probably about 15 years ago, and still using it to this day, and I use it because it's very reliable and it works. And one of the things that I like about it is it helps remove the subjectivity because it's a very mechanical based rule. So let's start with the pattern in general and see how it works. So what we're looking for on a daily chart or any time frame is looking for a last significant swing high on that time frame for a 1-2-3 top, or the last significant swing low for a 1-2-3 bottom. So you can see that this high is greater than that high. So that gives us our new number one point, or number one high counting point. So we have a 1, and then we pull down and we pull back up, giving us a 1, 2, 3. Now, how do we measure that? Our profit objective and our stops are very simple. The initial risk needs to go above the swing high or above the swing 1, not right at the high. Give it a little bit of a buffer. And if we were counting a 1-2-3 bottom down here, our risk would be below the number 1. As far as the profit objective, we simply measure from the top of the 1 to the low of the 2, and then measure that down. So we measure from here, which is approximately 675. Take the 675 down to the 635. That's about 40 cents. So we take it from about 635 down to about 6 cents, or 5.95 if you want to be technical. 40 cents is $2,000 per contract in the full-size wheat contract. Now, that's a pretty easy mechanical setup. We do have a unique tool that can find this for us, and that's just using the top and bottom indicators. So now you can see that I've added the top and bottom indicator. It auto plots this for us. This green arrow is your 1, the red arrow is your 2, the blue arrow is your 3, giving us our 1, 2, 3. This X, this white X mark, is showing you the breakout or the entry area below the number 2. We get that, and we come down and we tag target 1. Now this dark green line is target 2, and it's 2 times the distance of TP1. Now, although these are very reliable to trade on their own, we of course like to trade in line with seasonality. So we know that at this particular time frame, we have a bias to the short side based on seasonality. You can go back and do that for yourself and see how we behaved last time at this year, and you can see that we traded to the downside. So we know that based on a couple of factors here, high probability season analysis, as well as the high probability 1-2-3 top pattern, that is that extra confluence that gives us confidence to take a trade to the short side, and we can move on to the next opportunity. If you have any questions, feel free to reach out. Good luck, good trading, and we'll see you on the next update.